we should leverage all the tools that are available to us, right? And markets can provide significant efficiency. And ultimately, these markets, carbon markets, can help to reduce and remove carbon emissions at scale and at the lowest possible cost. You don't have to always do it within your internal sort of metrics and value chain. Long story short, I do think that there's a level of sort of realignment back to a market that has demonstrated higher integrity. And I think that long term, that will then translate to decarbonization.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is presented by Base Carbon, sensible carbon investing. For more information, visit basecarbon.com.
Welcome back to Carbon Frontiers 2025 on Smarter Markets. I'm Dave Greely, Chief Economist at Abex Technologies. Our guest today is Rene Velasquez, Managing Partner at Valitera. We'll be discussing the tale of two cities state of the carbon markets and the challenges and opportunities in getting carbon finance flowing. Hello, Rene. Welcome to Smarter Markets.
Hi, Dave. Nice to be on your podcast for the first time. It's an actual privilege. Thank you so much.
Well, it's great to have you here. You know, we've been talking with each other, it seems like for at least a couple of years, about having you on as a guest on Smarter Markets, and I'm glad we've really finally been able to make it happen.
So am I. I'm super glad. It's actually a privilege. I'm a big fan of your show, and it's about time we made it happen.
Yeah, I feel like we've been following sometimes parallel paths with Carbon Exposure Project and the other interviews you've done. And it's great because you're able to bring in your 15 plus years of experience in carbon markets, all the relationships you've developed, all the people you've met. And so glad to have you bring that experience and those conversations with you today. But maybe I just started off just kind of at like a headline level. You know, one thing we try to do on our Carbon Frontiers podcast is just give people a sense of where the leading edge of carbon markets is or where the path forward is. And probably the best place to start is just, you know, what's the state of the carbon market today from your vantage point?
That's such a great question. I think in summary, like I'll start with summary and then I'll give you a deep dive. How's that?
That's perfect.
Okay, good. So essentially, carbon markets are in a transition phase. And some say inflection point, and I think that they're the optimists, and I'll subscribe to that view. But certainly, it's never boring. And we see effectively a tale of two cities between compliance and voluntary markets. So that's the top level view. If you'll allow me to indulgence to kind of go down into a deeper dive. When we look at compliance markets, we see a growth in compliance markets. And just in terms of broad coverage, I lose count how many emissions trading systems now they are, but I believe somewhere close to, if not a quarter of the world's GDP is now covered with a carbon price. So I think that that's a really positive sign. And we're now starting to see more and more distribution of that signal with regards to pricing as a result of Article 6, in particular Article 6.2. So we're seeing the emergence effectively of systems at the member state level in order to now cover certain sectors and pass down these price signals across those various different sectors in line with their nationally determined contribution. We think that that will continue to grow. And parallel to that, I should also say that you've got other systems like Corsia that are starting to gain traction, and we start to see growth there as well. When I contrast that to voluntary carbon markets, that's a tale of two cities. Whether we see resilience and growth and kind of a steadfast direction, let's say with regards to compliance markets, voluntary markets have been very turbulent. I think that that's a fair statement to make, and obviously it's been well litigated and well discussed. But I do think that we're in an inflection point. Essentially, when we look back the last 18, 24 months, the voluntary carbon market has done a lot of reckoning, and quite rightly so for a lot of key and obvious reasons. But we've reckoned with this idea around integrity. And I think that is now mature enough, and we're starting to see the kind of the next phase, which is scaling. And what is lacking currently is a clear demand signal. And so we still need some items to align, most namely the tacit endorsement for companies to actually participate in the market. And that is in large part driven by hopefully adoption by bodies like the Science Based Targets Initiative and others of the importance of this tool that is carbon pricing. But I do think that during this sort of downturn, the market has really reconciled a lot of the infrastructure, a lot of the systems, a lot of the clear transparency imperatives and the integrity measures for the betterment of the market. That will translate over time into a much more robust market. Hopefully that's a somewhat succinct answer, but
No, it's perfect. And lots of things I'd love to dig into. The first is this notion of the reckoning with the issue of integrity in the voluntary carbon markets. Obviously, that's been a big issue for a long time. Could you give us a little flavor of what that reckoning has been like and where we stand on the other side of it?
it's a great question. And I think that reckoning really was fairly abrupt. And it was one driven in large part around concerns of overcrediting, in particular on the nature-based side. I think that now is under control. And what that reckoning has led to is the end-to-end integrity initiatives that are well defined by the Voluntary Carbon Market Integrity Initiative and the Integrity Council on Voluntary Carbon Markets, VCMI and ICVCM. And that allows for claims as well as the actual underlying quality of the governance standards and the methodologies underneath those to adhere to these core carbon principles. I think that's fairly now well defined and will continue to be iterative over time as we get more and more and more coverage by the ICVCM of the various different programs and of the underlying methodologies and projects then start to adhere to those CCPs. I think that is just evolution at play, maybe a little bit forced, but quite necessary. And so now the market is essentially building back better for that future. We see also within the market this presence, and also the signals are indicative on this on the bid side for more and more removals, whether they be nature-based or more durable removals. And that's a really bright spot within voluntary carbon markets. But overall, there has been this drag.
That's great. And I wanted to ask you, you had mentioned the SBTI, and this might be a little too soon to tell. So if it's an unfair question, then let me know. Because obviously the news a few weeks ago was Jeff Bezos's fund pulling out of SBTI. Part of that likely related to the new administration in the US. Part also, SBTI has been seen as by some as being impractical in some of the standards they've held. But I'm curious your take. Like, do you see them changing direction, or what direction do you see in terms of the guidance they can issue corporates who are trying to do high integrity offsetting?
That's fabulous. Let's dive in. So around the Bezos Foundation and their funding of SBTI, they'd made a commitment to effectively provide that investment early on, but it was dated, right? So they basically concluded that agreement, and then they just didn't continue to renew. I guess there was a catalytic in financing. That's then subsequently been filled. So I know that a lot of folks in the media want to conflate it as, oh, wow, look, now there's a capitulation because of the new administration. I don't know if I can see direct causality there. I'll just put that out there. But back to SBTI and their kind of ideological stance against the use of carbon credits. It's driven in large part because of this notion of decarbonizing the hard way, effectively reduce emissions before you actually compensate for them. And I think that lack of kind of understanding, especially of how markets operate, doesn't translate to reality. And I think that's what we're seeing. I'm far more concerned with the lack of continued participation by some of the really big corporates and to continue along the pathway of SBTI. I think that they're going to see an attrition with regards to many of their members. And that's driven in large part because of the reality of decarbonization is one that's difficult. And we can point to some names, but most of the very large mega cap tech stocks and tech companies, I should say, that started on basically as part of the SBTI target setting and then program, effectively have then walked away because their realities have shifted. Many of them have relatively low carbon footprints relative to their balance sheets. But despite making some really great gains with regards to efficiencies, their overall emissions trajectory was not steepening on a downward curve. In fact, they started to increase. And a large part is a result of the investments that they were making into artificial intelligence and the build out of data centers, which have a voracious appetite for energy. And that just shows the difficulty of operating in the real world versus to an in vitro, sort of in the lab context. And I think many of the folks that are within SBTI have this ideological viewpoint that is the antithesis of markets. They think markets got us into this trouble. We don't want to trust markets for this. And I think that really is ideological viewpoint that just won't bear results. We should not, and obviously I have a vested interest here and kind of talking my own book as a market proponent, but we should leverage all the tools that are available to us, right? And markets can provide significant efficiency. And ultimately, these markets, carbon markets, can help to reduce and remove carbon emissions at scale and at the lowest possible cost. You don't have to always do it within your internal sort of metrics and value chain. Long story short, I do think that there's a level of sort of realignment back to a market that has demonstrated higher integrity. And I think that long term, that will then translate to decarbonization. Why do I think that? Because we're seeing it all the time now. Companies that are walking back their climate targets because they realize, like HSBC just did last week, that they're not going to be able to meet their commitment to decarbonize by 2030. It's too close. And so they kick it back 2 decades. So I hope that the science-based targets folks realize that, as their name suggests, the science dictates urgency. And without a market-based approach, you cannot have a price signal internally in order to decarbonize and do the hard work of switching technologies and infrastructure, let alone drive the necessary emission reductions and removals in other places in real time. It's a compensatory approach. Because if you kick the can down the road, all of these emissions just continue to rise. I do remain optimistic on that front.
And I wanted to dig into the real world impact of being too extreme. Like you mentioned a few of them, like clearly if the major tech companies are choosing between, investing in AI and pursuing it versus decarbonizing, right now AI is going to win.
They have a fiduciary obligation to their shareholders and stakeholders. They're not going to give up an opportunity that's worth potentially trillions of dollars. And that is one of the big tectonic shifts in recent memories. Like, you're my generation, right? We grew up in sort of at the beginning of that internet age, right? And it's been hugely beneficial and symmetry. Also depressionary with a lot of other things, right? In terms of pricing and kind of also providing this growth on global networks. The generation that my daughter is in, the Generation Alpha folks versus our Gen X, they are growing up in real time in an AI environment. And that means that they can leverage these incredible tools to solve really complex problems like climate change. But there's a cost at which, that comes with the unlocking this very powerful tool set. And that's the energy piece. If the energy transition can actually go hand in hand with the growth in AI, and we see even further, more accelerated growth for renewables and battery storage and other forms of energy that don't result, for example, nuclear, that result with greenhouse gas emissions going to the atmosphere, then that's a good thing. If we don't use AI for, let's say, not so positive climate benefits like enhanced oil recovery tools, but we actually use them for helping to speed up technologies in the removal space, for example, then that can be good. But like any tools, it's who wields that tool that ultimately dictates what is the outcome.
And wanted to get your sense, as you're deeply involved in the market, what has been some of the impact of companies pulling back? 'Cause I think often people focus on the offset piece, they don't focus on the project piece. And I'm curious, what's been the impact on the ground amongst project developers? So I really want to talk about the state of carbon finance. How do you see the state of carbon finance today? And what's the real world impact that some of this pullback from carbon markets is having on project developers who are trying to get reduction and removal projects in place?
No, that's a great question. So the reality on the ground is that it's very difficult right now to access financing, whether that be equity, so akin to sort of venture type of financing, or debt. And where it is possible, it comes at a very steep cost. Why? It's linked to the risk appetite for those investors. And it's fairly lean on the risk side. And so hence it's fairly difficult to underwrite project developers from the financing side. What I do think is, though, that there's this kind of decouple. There's very large institutional investors that are looking at the long-term tail here of decarbonization, and they realize that markets will play a key role, and they're looking to get exposure. but the type of ticket sizes that they write, fairly large. Large institutional investors write big tickets. Project developers find it very difficult right now to raise money because oftentimes their ambition is fairly small. And why would they increase their ambition if they find it difficult to even get pilot and feasibility like projects off the ground? And so there's this decouple of very small opportunity, insufficient for institutional investors to want to bridge that gap, a lack of sophistication on that small end project developer. And it's akin to a cottage industry looking for big stimulus. And because of the price signals and the pullbacks that we've seen in the last 2 years in particular, the fact that there's less liquidity on it across exchanges broadly, both spot and futures, there's less liquidity all around as well. The risk appetite for the private sector, like let's say risk takers to come in and bridge that gap, has been fairly lacking. So basically the reality on the ground is that financing is difficult to get unless you can somehow cobble multiple projects into one very large pool, either at Topco or at an SPV level, to go and approach institutional investors. And the folks that can do that have to have the track record. So there are some bright spots. Like, for example, I point to Imperative, that's run by Scobie Mackay and KK and their team. They're fabulous. And they just recently raised $150 million from Artemeter, which is a DRW company. And that shows to me that there is appetite. And there's obviously other co-investors that will come in for deals like that, whether they be sovereign wealth funds or very large institutional investors like banks. So there is a part of the market that is there, but it's tricky right now without the price signals.
Yeah, that's a really fascinating point because it's not something that's limited to carbon markets. I think if you look out across all markets, all companies seeking financing, there's this kind of missing middle problem of you have institutions that want to write $50 million plus checks, or else it's not really moving the needle on their returns. And you've got companies that might only need 5 or 10. So they can't get the financing.
Exactly. Where's that middle? And it's risk propensity. So the venture capitalists have filled that gap for a very long time across tech and fintech and other sort of spaces, biotech, et cetera. Climate tech had its moment, but because of the recent pullback and the policy shifts, there are very few pure play venture capitalists that are looking at carbon exposure. And as a result, that middle, like you said, is difficult to bridge. And that's just the current reality. I think that as we start to see, my thesis is this: I'm actually concerned not about the current situation. I'm worried about the long term. Because I do believe, and I have a very long bias on carbon, again, talking my own book, but by 2040, it's a very different paradigm that we'll then see. Companies will not be able to decarbonize in the manner that they believe that they could, right? They're going to find that much more difficult than they set out to achieve. And they will be relying on carbon reduction, avoidance credits, but mostly on removals in that period. And I'm concerned about the lack of elasticity with regards to the response. So even when that signal comes in, let's assume it's 2030, that the project finance takes time to be realized, that then picks and shovels go into the ground, that there's a delay in effectively building out that pipeline. And then we see even further delays within the certification of those outcomes coming through. So basically, you put down the foot on the accelerator and you don't get a response for the next 3 years. And that creates really big swings in volatility. That's what I'm thinking about. But in the meantime, yeah, obviously we're helping to try to get project developers to become more sophisticated financially, to speak to the right folks, to be able to bridge the current situation.
Yeah, and I think people need to keep in mind that like any business, it takes multiple years and an industry takes multiple years to develop, particularly if you wanted to have the processes in place and the experienced participants that can produce what other people will consider high integrity. You can't just do that from zero. You need to give people time to get all that in place.
There are lots of examples of that, David. That's a really astute observation. We've had, when those markets have formed, and let's take AI or even renewables, right? The technology was fairly nascent and it took some time for the first kind of wave to emerge, right? Version 1.0. And then we started to see resolution of some of those technical delays in renewables. Let's take photovoltaics. Around 2007, 2008, we saw an increase with regards to the efficiency of a lot of those panels. And then we started to see stimulatory policy responses across Europe, Spain, Germany in particular, then the US. And then China came in and then effectively commoditized the creation of these panels. And that led to this kind of compression with regards to pricing. And then you had huge deployment and effectively followed what's called Swanson's law. In AI, it's the same thing. Like people have been working on AI as this problem, right? For a very long time, 30 years. And only now are we seeing the kind of the growth and acceleration really move forward. Carbon markets have been around for some time, 20 years, but that's the kind of the first, let's say, version. And now we've been going through this reconciliation, as we call it, and we're coming out with version 2.0. There is this lag. And what we need is essentially a realization that there's a dependency on it. And that's where the demand will build. Right now, on voluntary, that hasn't yet hit, right? This demand signal is not yet sticky enough. We need that to really catch into the gear for this thing to really start to move forward.
Yeah, and you paint a picture of a market where you would expect going forward there to be a lot of volatility, a lot of risk in terms of carbon prices with this kind of start-stop approach that's happening and not getting the investment that's needed. And it brings me back to, you mentioned earlier that many of these projects are more like a cottage industry. And typically, where do small businesses go to get finance? They go to banks. And do banks like a lot of risk? No, they do not. Is there any debt financing, or do you see a path for more debt financing in some of these projects?
The answer to those two questions is very little, but yes, I do see the potential. We've spoken to numerous banks. They've all expressed an interest in effectively exercising their loan book. Like they really want to deploy this capital. And some of them have really enormous loan books that are available towards climate related initiatives. And many early on in kind of 2020 and 21 were looking at how they could really deploy that finance. Today, again, it's this kind of situation around risk alleviation. They look at it very much in terms of that lens. And so they want it all. They're essentially saying, great projects, you could build it at scale, fabulous. We can provide you debt financing, but you need to come back to us with the de-risking. And then the developer and their partner on the commercialization side might say, okay, great, how do we do that? They say, well, we need to have offtakes in place with some very reputable corporate buyers because ultimately we're taking their credit risk. Okay, so now you have to structure deals with a Microsoft and a Google and these types of big clients, Volkswagen. And then come back and essentially how much of the total pipeline is now outlaid in terms of this de-risking. Then they do that analysis. Okay, now there's sovereign risk associated with the country where the project activity exists. You've de-risked the commercial risk to a certain extent. There's still the sovereign risk. Go and get us some insurance, right? So now you have to get sovereign risk insurance, especially if corresponding adjustments are there, and so on and so forth. And so essentially they want it all wrapped up in a beautiful package with a pretty pink bow on top. And then they'll unlock that financing. And that's a really tedious route to go, and I understand it. I think what we need is some catalytic financing, either through multilateral bank participation, sovereigns, and others coming in, providing some level of guarantee around the types of projects that they will back. And they look at it on a holistic basis to say, okay, show us 100 different types of projects and we'll rubber stamp effectively, 10%, whatever it might be. The commercial banks can then take that paper and then effectively they can apply it and they start to become less stingy, let's say, with that financing. And then we can start to see more unlocking. There will be winners, there will be losers. They need also collateralization. That's where it's currently tricky right now because if there aren't any assets, let's say you're planting a mangrove or a forest, it's not like they're familiar with these natural assets, right? They're familiar with airports and buildings, something that they can kind of take the keys back if you go under. And so a lot of the project developers might say, oh, you can get paid in a stream of carbon credits. And then when the risk teams at the banks try to price that, who's on the bid? And this is dislocation, right? So you need basically all the parts of the systems working. You need spot contracts, futures contracts, you need high level liquidity, et cetera. We're not necessarily seeing that. So it is a chicken and egg kind of thing, but it'll be worked out.
Yeah, and it sounds like there are a number of pieces that sound very familiar from traditional natural resource markets. I come from the energy side, and it was very natural for energy companies, natural gas companies to get offtake agreements, to lay off risk on the forward curve, to kind of take the price risk out of the equation so that they could get that bank financing or debt financing. But as you said, it takes a financial ecosystem around it because you need place to lay off the risk, you need insurance, you need a lot of these pieces that you're seeing it form in carbon markets, but it's not like it's been there for a long time. It's still relatively new. Do you see movement towards building out more of that financial infrastructure, or is that the catalytic piece that you need some big first movers?
I think we are seeing it. And again, I kind of refer to the bright spot. I think on the, let's say, durable CDR space, so think things like enhanced rock weathering, direct air capture, these sorts of long duration assets with regards to sequestration of thousands of years, biochar in the hundreds of years, and then you started working down. As you kind of go for these longer duration removals, there is appetite to go out there and, well, certainly there's demand on the offtake side. But then as a result of that and the types of companies that are structuring these offtakes to then provide that finance, it doesn't hurt that these are hard assets. Think CCUS, direct air capture, things that have bells and whistles, that have gauges that are there, they cannot be picked up and moved across. And so banks, I think, understand that more from the project kind of financing piece. I think when it comes to natural capital, I think that that's where it's a little bit tricky. And ironically, that's where the scale exists. And so I think that bridging that gap is going to be really tricky. I think the catalyst for that is ultimately this intersection with the Article 6 world. So as countries start to look at nature-based solutions as a natural resource, essentially, that they can export part of in order to trade with other countries, you then start to see sovereigns emerging as counterparties. And that demand then flows into compliance markets in those other countries. And so you start to see trade flow and you start to see bridges being built between country to country through this Article 6.2 bridge kind of creation. I think that that's really the catalyst. And banks would obviously want to then take the paper of a sovereign. Obviously, there'll be different ratings and different kind of costs for that finance, but that'll, I think, start to unlock quite simply. And the key piece is the corresponding adjustment. Once we start to see those start to flow, and we start to see those better down in regulation, the bank's risk appetite really starts to emerge.
And I know you've taken a very entrepreneurial path in your own work. And I was curious, what are you up to and how are you navigating the carbon markets these days?
Yeah, no, great question. I seem to be wearing lots of hats, Dave. I left a very comfortable job at a really great company after having been part of a team building up really great infrastructure, and that company was expansive. And in order to pursue this entrepreneurial journey. So what am I doing? The first thing that I did was to set up our own specialist advisory and portfolio management trading firm. It's called Valitera. So I work with 3 wonderful partners and we build a small team. We believe small is beautiful. We really want to focus on delivering high quality and services and really delivering value to our clients. The word value, it resonates a lot with us. It's actually a core part of our name. People ask me, where did you get the name Valitera? And it's value, impact, and earth. And we wanted the name to effectively be translated into multiple languages, Spanish, Italian, French, whatever it might be. And we wanted something different that didn't have the word carbon in it. So we spent a lot of our time there speaking with both buy-side and sell-side clients, helping them to, on the buy-side, to access and understand better the market. And so we provide market intelligence. And then we help them to construct portfolios and effectively go out there and execute them. It's a playbook that's been run a number of times, and I spent my career effectively doing that. And essentially, we're leveraging our expertise. So that's what I call the analog solution that I've been focusing on. And it's been really great. We've got an awesome team and a global presence, I might add. And then the digital piece, it's funny roundabout way how I came about it, but effectively I came in as an angel investor to this startup, and where the founder had this dream of building out effectively the Robin Hood for carbon markets. Effectively, his ambition was to democratize carbon markets. A few months in after writing the check, and ironically, my partners also, and I also wrote the checks, I said to the founder, hey, who's going to be running this? And he said, I was hoping you could. So now I'm also the CEO of a company called Carbon Trade. And we're building exactly what I mentioned. Essentially, we're starting out with the first product, which is a mobile app with the ambition to democratize access and participation in carbon markets. And we're trying to innovate and build that out. So we now announce that we come out of stealth mode. We begin a beta testing process, I guess, or program, however you want to term it, in the next few days. And then we'll continue to iterate and build that. And we hope to have something launched sort of by the end of the year. There are some regulatory hurdles that we'll need to overcome. So that's that. And then part 2 of that kind of journey, I'll keep listeners in suspense, but it follows that same trajectory around democratization. There are more folks than just the mom and pop and individual investors, but there are other folks that want to gain access to this market and find it very difficult to, just because we've, as a market, made it difficult to access. Effectively, it's geared towards enterprise institutional investors. We've, I think, avoided or distanced ourselves or ignored retail, and we've ignored SMEs, so I think to the detriment of liquidity. And our thesis is that we want to bring them back. We want to make the market accessible to everybody. We've seen some corollaries for that, and we think that the timing is right to build that business. So that's what I'm spending my time on. Like you, I also believe in distributing content to a wide audience with the ambition to help to share the knowledge, to make the market more accessible. And quite selfishly, if anything that I say or that other guests that I interview say can effectively motivate a young person to step into the market, maybe that young person is transformative and helps to come up with an idea to sort of bring the market forward. So I've got the carbon exposure project that keeps me busy. And then we just launched another one over Zoom called This Week in Carbon. So I'm pretty busy. In the meantime, also raise a 4-year-old. And so ask me how much I sleep.
The last thing I wanted to ask you, and the reason I asked you the prior question is because I think there are still a lot of young people, many being young people, or at least younger than you and I, who want to get involved in climate work, who want to get involved in carbon markets, carbon financing, project development. And I think that path has become less certain, more ambiguous, more difficult to access for many. So I was curious if you were to give advice for folks who now want to get involved, what would that advice be?
This is such a key area of passion for me. What I would say is focus on the problems that really resonate with you, that are either existential or that you think that you can provide value in terms of providing a solution for. Focus on solving those problems and you will find a very rewarding career path. Focus on the money last, right? The money comes, right? If you chase excellence. And if you chase problem solving, investment comes, great opportunity. Just focus on having fun. If you're young, tend not to live a very expensive lifestyle. Right? Just focus on solving the problems. Carbon markets, as per our conversation, we've highlighted at this really amazing inflection point. They're growing. They need greater participation, challenging new ideas, challenging the status quo. We need new blood. And some of that is disruptive, but some of that is really constructive. And I really think that because the young people, I'm talking, Gen Z and eventually Gen Alpha, they're the ones that inherit the world, right? After you and I are gone. Which may not be for a while, but ultimately they're the ones who inherit the planet next. And if ourselves, our generation, our predecessors have left it in a much warmer context, they have now a vested interest to try to rectify that solution. So come up with a solution, focus on that, help to accelerate the energy transition, help to accelerate the growth in carbon markets, help to whatever motivates you, make something and deliver something with change.
Thanks again to Rene Velasquez, Managing Partner at Valitera. We hope you enjoyed the episode. We'll be back next week with another episode of Carbon Frontiers 2025. We hope you'll join us.
This episode is presented by Base Carbon, a financier of projects involved primarily in the global voluntary carbon markets. Base Carbon endeavors to be the preferred carbon project partner in providing capital and management resources to carbon removal and abatement projects globally, and where appropriate, will utilize technologies within the evolving environmental industries to enhance efficiencies, commercial credibility, and trading transparency. For more information, visit basecarbon.com. Base Carbon, sensible carbon investing. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.